Commodity currencies are fundamentally different from the major currencies like the euro or the yen. Their value is tied directly to the price of raw materials exported by their home countries. The Australian, New Zealand, and Canadian dollars are the three most liquid examples of this, and understanding their drivers gives you an edge in trading. Let's start with the Australian dollar, the Aussie. Australia is one of the world's largest exporters of iron ore and gold. When global demand for steel rises, iron ore prices spike, and the Australian dollar typically follows. Similarly, gold acts as a hedge against inflation and uncertainty. When gold rallies, so does the AUD. This is a direct correlation, not a coincidence. Next is the Canadian dollar, often called the loonie. Canada sits on massive oil reserves, particularly in the oil sands of Alberta. The Canadian dollar moves in lockstep with crude oil prices. When geopolitical tensions or supply cuts push oil higher, the Canadian economy benefits, and the CAD strengthens against the dollar. Conversely, a collapse in oil prices always drags the loonie down with it. Now consider the New Zealand dollar, the Kiwi. New Zealand's economy is heavily agricultural, with dairy being its primary export. The price of whole milk powder and butter directly influences the Kiwi's value. When global dairy prices rise due to supply shortages or increased demand from Asia, the NZD follows. It is a niche correlation but very reliable. This correlation works because these currencies reflect the health of their export-driven economies. A rising commodity price means more revenue, a stronger current account, and higher demand for the local currency. It is not just speculation, it is fundamental economics playing out in real time. The beauty of trading these correlations is that you can use one market to confirm moves in another. For example, if you see crude oil breaking out to new highs, you have a strong bias to buy the Canadian dollar. If gold is plummeting, you should be looking to sell the Aussie. They act as confirmation signals. You can also trade the divergence. Sometimes a commodity currency will lag behind its underlying resource. If iron ore is surging but the AUD is flat, there is often a catch-up trade waiting to happen. This lag happens because the market is slow to price in the data, providing an entry opportunity before the crowd catches on. These three currencies offer a clear, logical framework for trades. Instead of guessing based on vague news, you have a concrete indicator to watch. Keep your charts of oil, gold, and dairy prices open alongside your forex charts, and trade the correlation. It is one of the most straightforward edges available in the currency markets.